Welcome to this explainer. Today we're unpacking a really critical investment committee memo, and we're going to dive straight into our analysis of Egypt as a strategic emerging market opportunity. Look, if you're managing capital right now, you already know the drill. Your board is demanding growth, but those global macroeconomic headwinds, they are incredibly stiff. So, as a financial expert advising your fund, I want to show you exactly where the smart money is looking next. Here's a quick look at our agenda. First, global volatility and energy risks. Second, the Fitch rating upgrade. Third, unlocking the golden license. Fourth, high-growth investment sectors. Fifth, the regional green energy hub. And finally, chasing the $60 billion target. All right, Section 1, global volatility and energy risks. You really can't evaluate an emerging market without first understanding what investors are running away from in the developed world. $97.56. We recently saw a rapid 1.5% jump in Brent crude prices, straight to $97.56 a barrel, completely triggered by geopolitical tensions and military engagements between the US and Iran. And honestly, this just highlights the severe energy market volatility we're all dealing with right now, because when Middle Eastern supply chains get threatened, energy prices spike, and that immediately bleeds into global inflation and manufacturing costs. And when we compare how central banks are being forced to react to these shocks, we're seeing a massive divergence. You've got the European Central Bank facing this incredibly sticky inflation driven heavily by energy costs, and they're leaning towards even further tightening. We're potentially looking at a 25 basis point rate hike in June. But meanwhile, the US Federal Reserve is facing a totally different crisis, potential structural changes to how inflation is even measured. Basically, adopting a new underlying inflation index could mechanically lower reported inflation by a full percentage point. And that leaves markets highly uncertain about the true cost of capital, not to mention the independence of these institutions moving forward. Moving to Section 2, the Fitch rating upgrade, and looking at Egypt as a strategic hedge. So with Europe tightening and U.S. policy facing all these structural shifts, capital is naturally searching for a strategic hedge. And according to a really comprehensive recent Fitch report analysis, Egypt now ranks third in the entire MENA region for investment openness. Guys, this is a massive signal. Institutional investors rely heavily on these exact metrics, and it clearly indicates Egypt's structural readiness to absorb foreign capital effectively. But we have to understand why Fitch gave them this ranking. It isn't just based on empty promises. It's built on tangible, measurable metrics. First up, you have their unbelievable geographic advantage, literally acting as a bridge connecting Asia, Africa, and Europe. Second, a massive internal consumer market of over 110 million people. Third, they've poured billions into modern infrastructure, ports, and logistics networks. But perhaps most importantly for institutional funds, Egypt recently transitioned to a flexible currency exchange rate. We all know foreign investors absolutely hate opacity and multiple exchange rates. So by floating the currency, Egypt removed a huge layer of market friction and brought some much-needed clarity to capital entry and exit. Okay, Section 3, unlocking the golden license and streamlining capital entry. So how is Egypt actually getting this foreign money through the door? Well, to solve historical bureaucratic issues, because let's be real, we all know the absolute pain of needing 12 different stamps from 12 different ministries just to lease a piece of property, the government introduced what they call the golden license. This fundamentally transforms how capital enters the country. Instead of a labyrinth of red tape, it's now a streamlined online application that leads to rapid, unified approval. It's essentially a single point of clearance designed specifically to fast-track foreign direct investment. Because at the end of the day, for institutional investors, time literally equals money. Any delays in securing permits just mean delayed production, disrupted supply chains, and ultimately lower returns. By stripping away that bureaucratic friction with the golden license, Egypt is directly increasing operational efficiency and the overall return on investment for foreign enterprises setting up shop in the region. Let's move to Section 4. High-growth investment sectors. Where is the capital actually flowing? With the gates open, where exactly is the smart money going right now? Based on the current market data, capital is heavily targeting three main pillars. First is tech and outsourcing, which is backed by this massive initiative to train 800,000 young people this year alone in AI, data analytics, and cybersecurity. Second is logistics and industry, entirely centered around the Suez Canal economic zone. And third is renewable energy, leveraging the incredible natural resources in places like Benban and Aswan for year-round solar and wind generation. I really want to zero in on the Suez Canal economic zone for a second, because its strategic value right now is just off the charts. As global supply chains face more and more choke points, the SC zone acts as a perfect insulator.
It offers a centralized manufacturing and logistics hub that basically serves as a direct export pipeline to 3 continents. It's taking raw geography and transforming it into measurable economic power. And this is totally validated by the significant collaborative investments pouring in from Gulf nations, who clearly view this zone as a long-term strategic asset.
Section 5. Regional Green Energy Hub.
Connecting this all back to the global energy crisis we touched on earlier, we are seeing a massive divergence in strategy. While major European industrial sectors, especially things like automotive and mechanical engineering, are literally shedding tens of thousands of jobs due to the crushing costs of volatile fossil fuels, Egypt is taking a completely different path. They are heavily capitalizing on their geographic advantages in solar and wind to build a really resilient green energy grid. They're pivoting away from the exact energy sources that are currently crippling Western manufacturing. And this leads us to a huge future growth engine. Egypt is securing a really critical early mover advantage in the global green hydrogen market. By aggressively executing green hydrogen agreements ever since hosting COP27, Egypt isn't just attracting initial foreign direct investment. They're actually creating entirely new, sustainable export industries from scratch. And let's face it, the countries that build this infrastructure first are going to be the ones dictating the clean energy markets of the next century.
Finally, Section 6. Chasing the $60 billion target.
Look, it's one thing to have the right sectors and the right licenses, but what is the ultimate scale of this ambition? Well, here is the number that is driving the country's entire economic policy right now: $60 billion. Egypt has set an incredibly ambitious, publicly stated target of attracting $60 billion in foreign direct investment by the year 2030. To truly wrap your head around the sheer scale of that number, you have to look at the context. In some recent years, the historical annual average of foreign direct investment for the entire African continent combined has hovered around $55 billion. Egypt is aiming to pull in $60 billion as a single nation by 2030. That is wild. It really highlights their aggressive ambition to transition from a developing market straight into an inescapable economic powerhouse for the region. But look, ambition requires execution, right? Achieving this target is absolutely not guaranteed. It's going to require the relentless continuation of these economic and legislative reforms. The golden license can't just be a passing phase. They have to prioritize productive, industrial investments that actually generate hard currency exports, not just short-term real estate plays. And above all else, they have to maintain unwavering policy stability to ensure the deep, long-term trust of institutional investors. Because capital loves growth for sure, but it absolutely requires predictability. Which brings us to our final takeaway. As we wrap up this explainer, the ultimate question for you and your investment committee is this. As inflation, energy shocks, and unpredictable monetary policies keep global markets in a constant state of flux, can Egypt actually sustain its current reform momentum? Do their geographic advantages and aggressive business incentives offer enough upside to outpace the friction of global macroeconomic volatility over the next decade? The data definitely suggests the foundation is there, but the execution over these next few years is going to dictate exactly who captures that $60 billion prize. Thanks so much for joining me for this explainer, and I'll catch you next time as we continue to unpack the forces shaping the global economy.